G'day everyone, welcome back to another episode of Spark Your Fire. I'm your host David Shih. Along with me is always Mr. John Comino. How are you doing, John?
I'm good. I'm good, David. How are you doing?
Good to see the smiling face on Fridays as always.
Yeah, that's right. No, it's happy days, good weather. It's Friday, so I mean, we're both 7 days a week workers. Friday, Saturday's a busy day. Got to get out there and hit the pavement, but yeah,
Absolutely.
life's good.
I can already see you're wearing like t-shirts already. So the spring is on the way.
It's slimming.
Yeah, it's unusually warm this year, isn't it?
Yeah.
At this
The last
time of the
couple of days
year.
have been.
Yeah. I'm still gearing up, mate, just to keep my winter outfit as always.
Yeah,
So.
nice.
But look, good to see you. And I think there was a slight rejoice in terms of the August rate decision earlier this month, which RBA decided to be on a pause. And this happens to be the second last meeting that our current governor, Philip Lowe, is going to be in. September 1 being his last one before our new RBA governor, Michelle Bullock, currently the deputy governor, is going to kick in. So it'll be interesting. But look, the detailed minutes hasn't been released yet. But as far as the information or the intel that I can collect so far, they want to buy more time to see what's really happening in the economy side of things. Certainly, the CPI numbers, the quarterly CPI numbers have all came back, exceeded expectations in terms of more under control in that sense. So that's good news for everyone. And certainly the pause this month was mainly welcomed, pretty much all welcomed by all the mortgage holders across Australia. But yeah, so it's a good outcome, I think, personally. And what do you think, John? Do you still think that there's going to be another one coming at this point, or?
Yeah, I've always thought Governor Lowe might throw a grenade on his way out. Then like block his ears as he chucks the grenade in the doorway. I don't know if I still think that. He's only got what, two? Did you say two more meetings?
No, the next month will be the
One
last
more
one.
meeting. Right. So if they're going to do it, it'll be the next meeting,
Yeah.
but probably not. So you mentioned CPI. CPI is coming in cooler than expected. The US, and the US is relevant because they have the reserve currency, but the US came out with its inflation numbers last night, and they were 3.2%, and they were lower than expected. The market expected 3.3%.
Awesome.
So there are expectations that inflation is cooling, and as we said in the pre-match analysis, they're going to be within range very, very soon. So once it gets under 3%, they're going to start to get close to their range.
Mm.
So there probably isn't a case for another rate increase, but I don't want to assume they're not going to do it. Just one last thing. I saw a chart today, again in the US, but Australia's monetary system rhymes. There has been deflation, as in a contraction of the M2 money supply, for 9 months in a row. That's technically the technical definition of deflation. So this is the first time this has happened since the Great Depression, where you've had 9 months of a contracting money supply. So we should start to see that come in through negative CPI in the next year or so. When the money supply shrinks, you get falling prices. So we haven't seen it in the CPI yet because the CPI lags, but M2 money supply is contracting. We haven't seen that since the 1930s, and there are lots of reasons for the RBA and the Fed to pause before dropping rates, because we might be staring down, the path of deflation this time next year. But I mean, again, crystal ball, it's hard to know. No need to do another rate rise, I would have thought, and I think we might be begging for inflation this time next year, according to Grant Cardone. But who knows?
Interesting about how quickly these numbers are moving, right? And look, anecdotally as well, the economy is definitely slowing. The retail numbers are coming in very, very weak at the moment. The coffee shops are probably the first one that gets impacted in terms of, the people are coming in just for coffees and not buying meals, as you can imagine. Also, unfortunately, I'm starting to hear my clients, at least a few of mine, have started to be made redundant as well in the industry, which is an unfortunate fact for everyone. And it is difficult time for people. I think it's going to start to reflect on the unemployment numbers. I know it's still record low right now, but RBA, I think, has also adjusted their forecast on that moving forward, anticipating probably around about the 4.0 by the end of this year, and then maybe around the 4.3 towards mid to late next year as well. So unemployment number is going to track up in that instance, and I think that's going to be the key determining factor next in terms of when RBA will decide to reduce rates. So I think the general consensus, though, is that they're not going to drop rates very, very quickly, are they? They're going to hold it for a while. They're going to see how things pan out. They're going to make sure that inflation is killed to the point where it might even go to deflation before they would actually make their next move. What do you think, John?
Yes, I don't think they'll do anything this year, even if we start to see some quote deflation. I'm not a big fan of the CPI as a measure, but if we start to see it come right down, I still don't think that they'll lower rates this year. That said, it's all August, so there's not much of this year left.
That's true.
So that's not necessarily a problem. Yeah, I think they'll hold it for a bit. I think that 2019 was a lesson for the central banks. If we go back to 2019, there was a bit of a rattle in the stock market and they started lowering rates. Now, they might have, a sinister person might say that maybe they knew something COVID-ish was coming down the pike, but Trump was putting pressure on Chairman Powell at the time to lower rates for political purposes, right? So I think that they won't make that mistake again. There was no reason to drop rates in 2019. And so I think that if there's a bit of a shake in the stock market, and bearing in mind the stock market's been on a tear for the last 9 months. This year, the stock market, particularly tech, has been on a tear. I think if that starts to wobble, I think they will hold their nerve for a bit. And I think that they won't do what they did in 2019.
Well, hopefully they learn a lesson this time. That's all we can.
Don't count on it.
But look, you got to trust these central bankers know what they're doing. So we'll see. Okay. Good. All right. So, but at least that's a good outcome for the mortgage holders this month, and hopefully it'll remain the same. And the only trajectory, hopefully, is down on the cash rate from this perspective to make everyone a bit happier and the mortgage holders a bit happier. So, but I guess on another news, we've got the July CoreLogic data coming out as well. Pretty much everything has slowed, even though they are still growing. So the figures are still positive. We're talking about, the index as at 31st of July, we're still looking at, Sydney still record a 0.9% increase. That has dropped from a 1 point something, but then again, has slowed, but it's still a positive growth. Brisbane and Adelaide both being 1.4% are the accelerators in last month. So these two cities are kind of like the outliers, followed by Perth at 1%. And Hobart and Darwin, Hobart 0%, Darwin at 0.3%, and Canberra a negative, minus 0.1 actually. So Canberra's coming back at the moment. So I think overall the summary from Tim Lawless really is the growth is still the pace of the growth has slowed essentially in the last couple of months, and that's to do with both prices as well as the rental increases, essentially. So the rent increases has started to show a bit of slowed in that sense. The supply, however, which is what we've been monitoring for a while, because we all know that the high level of prices or how it's being maintained at the moment is because of the shortage of the supply that's available. The supply or the new supply in July has actually gone up. So it has actually increased, defiant from usually the winter quiet season. I wonder whether it's to do with the early spring that we're seeing this year, but that might be a coincidence because of the fact that some landlords have decided to start selling due to the fact that the fixed rate cliff is also rolling off. So but the flow of new listing added to the capital city housing market has increased by about 3.9% in July. So that's about 4%, which is big jump. I actually think big jump in that instance. So as we touched on about 2 weeks ago, there was a clear trend in terms of investors started to sell. If you could recall that graph, we spent about 10 minutes discussing, interpreting that graph to show the Sydney investors or Sydney landlords is consisting almost about 40% of the total selling listing now. So I think those are probably what's really fueling the new listings at the moment, to a degree as well. So, but yeah, look, I think the key words here is really prices, supply, and rent, as well. And I think, John, you've got a bit of interesting insights there to share about these factors. What are your highlights, actually, out of last month's CoreLogic data?
Well, I think that the market is still going up, but it is starting to flatten out. I mean, the market's going up at 6% a quarter or thereabouts. I mean, I've got a bit of a Sydney focus, but the market's going up at 6% per month. You can sort of look at some of the smaller capitals as 6 to 7 months behind Sydney. So I don't expect the momentum in Brisbane, say, to slow down. I suspect that they're going to be speeding up. One of the interesting things, though, just add a little bit of value to this chat, is what's interesting is the different tiers. So the upper, middle, and lower quartiles of the market. So in Australia, or let's say Brisbane and Melbourne, it's the lower quartile that's going. It's actually been the most stable over the last couple of years, the lower quartile. So the entry level suburbs have been stable, but they are rising the fastest in Australia, except Sydney. In Sydney, it's the upper quartile, it's the premium areas that are rising the fastest at the moment. So that's very, very interesting. One of the things that when we look at the different tiers is that in Sydney in particular, the upper quartile has been quite volatile. So the upper quartile got hit the hardest in 2022 when the market crashed. But actually, the upper quartile ran the hardest in 2021 when the market was hot. Right now, the market is sort of hot again, really, and the upper quartile is going the hardest in Sydney, but actually it's the inverse everywhere else. So that's quite interesting. But apart from that, the market, there is some evidence the market is starting to plateau, but it's still rising. And so, if we say, I'm very cautious to say that it's flattening out, because it's flattening out with a bias to increase. So if we're going from 2.5% a month to 0.75%, that's still fairly good capital appreciation. I mean, the market's been up about 12% in the first 6 months of the year. Yep. I mean, I'd be quite happy with less than that for the full year. So it's been a very significant increase in prices. One last thing, we're nearly back at the all-time high. We're nearly at 2021 levels. The market peaked out in the previous kind of bull market at the end of 2021, and we're only 1% below where we were a year ago, which is to say we're sort of back at those levels. Interesting. Property's doing what property does. But the one difference is that we are at the same levels as we were 12 months ago, give or take, a little bit lower, but rents are about 20% higher. So the market has readjusted the real estate equation of whether it's worth buying. So rents are 20% higher, but the prices are the same. So this is the Warren Buffett weighing machine that he talks about. So that's interesting too.
Yeah. Now, it's a good point that you made about the upper and the lower quartiles. I think certainly the logical explanation of that is there's a lot more wealthier people in Sydney that can play that game in the upper quartile. And whereas for the other cities, the lower quartile are the affordable corridors, which are generally speaking at the moment, due to most people being hit with the borrowing capacity dropping by about 30-40%. So that's all they can afford, and that's the market, or that's the quartile that they have to compete in that sense. So therefore pushing that up. So those quartiles are probably performing most steadily in that case, and hence the explanation in that to that regard. But funny you say that. We're almost at 2022 highs as well, like 2021. Like it's not that long ago when everyone thought that with interest rate increasing so sharply that there's going to be a correlation in terms of the property prices. that didn't last for long, did it? Basically, it came down a little bit, but then it bounced up again very, very strongly.
Yeah.
Although I think this proves to be that property is always demand and supply driven at the end of the day. Like, even though, we're seeing such a phenomenon at the moment with such high interest rates from historical level, probably on the average type level, but given how much debt that most people have taken on, this is now classified as the new highs, in that sense. But the property prices hasn't really reduced much at all. In fact, as you said, we are pretty much at the peak or very close to the previous peak at the moment. So, and that's mainly driven by not many supply, lots of demand with a lot of immigrations coming in. They all need places to live. They all need either to rent or to buy. A lot of them is probably skipping renting at the moment, given how difficult it is. They go straight to buying, which then, increases that demand again. But supply, there hasn't been any materialistic increase in supply at all.
That's right.
Yeah.
And there are more houses, more citizens. We're a bigger country and we've got less supply, so price has to adjust. The interest rate argument is very interesting. I hear, like interest rates can't be the only reason why property prices go up and down.
Yeah.
Obviously, if interest rates that say that 6%, if you draw and if you see a chart of interest rates over time since the year 1800, let's say, and you draw a straight line where we are now, say 6%, there would have been 20 times that interest rates were 6% in the past, over the past couple of hundred years, but all at different prices. Yep. What's more important than the interest rate is the amount of currency in the system. I mentioned M2 before, so it's the currency supply, the availability of credit, is what determines the price of everything in the economy, including property prices. So we have a constant inflationary bias where the RBA is constantly putting new currency units into the system. That's fine. That's totally fine. But if the amount of currency units increases faster than the production of goods and services, or if it increases faster than the population is growing, and the population is growing at a little less than 1%, so wherever they're creating more Australian dollars than there are people, you're going to get inflation. Yes. And that's why the interest rate doesn't really matter. It's the currency supply. There you go.
There you go. Debunking another one of those myth that's out there, I guess.
Sacred cows.
Yeah, that's it. But it's also interesting because I guess, we touched on this before we jump on the podcast as well. We're already seeing a property prices that's beyond belief to a degree, like unaffordable in most people's opinions and eyes. But based on the 18-year rule, we are still going to be seeing another shoot up until 2026. Now, obviously, it's all purely hypothetical. We don't know when it will happen, but we can only do so much looking in the past and try to predict the future.
Yeah.
But if that 18-year rule does materialize, that means we're going to see how much what percentage jump until 2026 again, based on where we stand. Do you know roughly? Would that be another 20%?
We're trying to rationalize why the market would be going up when serviceability is lower and all these sorts of things. So to some degree, we're still paying the piper for the COVID lockdown. So during COVID, they increased currency supply by 25% in 1 year. So that had never happened. That was quite irresponsible, and that led to this overall inflation. Real estate's no different. But you're right. There are these theoretical models that that lay out these predictive models around underlying the 18-year cycle, 18.5-year cycle. We're on track for increased property prices until 2026, according to that model. Now, you don't want to put too much stock in a model like that, but it seems to be playing out. I'm actually a loose believer in the 18-year cycle. So I'm quite comfortable. I remember when the property market was sort of correcting around 2017 to 2019. I remember saying, "Oh yeah, this is the 2-year mid-cycle correction. We're going to be good. We're going to be good." And then in 2019, it took off again. So yeah, hard to know. Don't put too much stock in it because you still need to live somewhere. But I can see it going higher. The one thing I'd say about that is that if the 18-year cycle is right, and if we're going higher until 2026, what it does mean is that the last 2 years of this cycle, let's say 2025 and 2026, or 2024 to 2026, the last 2 years are what they call the winner's curse. And the winner's curse is when property prices go ballistic, but then they crash after that. So we could see, the model, if property prices were to go ballistic from 2024 onwards, which is what the 18-year cycle would be suggesting, it means that they're probably going to start to lower interest rates next year.
Yeah. Okay. Yeah, that would be in line with, because that would essentially be lighting the fire underneath the property barbecue.
Yeah, that's right. So that's right. So you might have a recession in the economy, but you might also have a property shortage, a population explosion, and you might be seeing sort of the housing market going up as the rest of the economy is in the doldrums. I mean, that's entirely possible. And recessions don't need to be deflationary. Recessions quite often, and you ask anyone in Zimbabwe or Argentina, recessions can quite often be inflationary. So that could be quite possibly what's going to happen over the next couple of years. We enter some sort of inflationary recession.
Yeah. Interesting. Okay. All right.
We'll see.
We'll see how that plays out. But yeah, it is difficult to fathom, I guess, in terms of how, I guess. But we'll see. History always repeats itself to a degree, and there's always a trend. So.
Yeah.
Okay. All right. Well, look, I think that pretty much covers all the data perspectives or data points that we want to talk about. But I know you mentioned there's a very interesting topic that's floating around at the moment on Property Chat in particular. Is it whether it's worthwhile keeping, or whether it's worthwhile being a landlord at the moment, given how all these rules that's being implied to, whether that's rental increases to how many times a year, rent freezes, that kind of things, and restrictions here and there. And, we all see that a lot of times the government doesn't necessarily support, I say loosely, support property investors to a degree. And that could be, charging extra land tax and that kind of things, as we're seeing in Victoria. Is it currently worthwhile to be a landlord or becoming a new landlord or that owns a property as opposed to investing into an ETF? So I think that was an interesting discussion point that's worth putting on. Now, before we start this, obviously, I think our listeners will understand that we are very pro property. So, so sometimes we may be making comments that's got a bit of a lens there, but I think both John and I agree that we will try to put that property hat off a little bit, and then see whether we can try to make this as an discussion as we possibly can, I guess.
Yeah. I can't promise I'll be objective. I'm definitely a property guy. So listeners, I jokingly say, if people ask me if it's the right time to buy a property, it's like asking the barber if you need a haircut. So asking a mortgage broker and a buyer's agent whether they prefer real estate to other assets is sort of like that. So please do your own homework and take your own view on these things. And these are just opinions.
We'll try to take off those hats and just be talking as investors or more than investors.
Yeah.
But yeah.
So do you want to go first, David? Do you want to give
okay.
ETFs,
so look, I think,
or even shares versus
Yeah. Look, I'm not a big share guy. At the end of the day, I think, it's obviously we create this property podcast, talk a lot about properties, but there are certain times where there's a lot of headwinds in the investing game. And I think at the moment, property is one of those that's currently experiencing quite a number of headwinds for especially new entrants into the game. So, with a lot of when people talk like a few years ago, there was a lot of cash flow property being really the buzzword. Cash flow properties, you want to buy cash flow properties so that way, it can actually generate passive income for you. It's easier to hold, that kind of stuff. In today's interest rate environment, it's literally impossible. Like, even if you're talking about a 6 to 7% type of rental yield, you're going to be paying like, $200, $300 or something. So holding costs have started to line up, not to mention, as a mortgage broker myself, I'm seeing borrowing capacity across the board has dropped about 30 to 40%, depending on where you are at the moment. So all these headwinds are currently basically saying that it's a very difficult time to be investing in property, and that's why a lot of people don't do it in that sense. And coupling that with all that negativity news that's coming from, the Victorian government increasing land taxes for property investors. They've tried to basically limit the rental increases up to, I think, once every 2 years. That's what they're trying to do at the moment as well. So yeah, I guess the moral of the story is there is currently a lot of headwinds against property investors. Is it worth it? Is it worth it though? Look, my perception is you try to do something contrarian to other people to a degree. Like if you keep following the herd, then you're just going to be another one of those within the population. It is difficult, but it doesn't mean that it can't be done at the end of the day, right? I think if you, and look, I think this comes back to, again, you got to look at property as a long-term game. There's going to be, it's a difficult time to be entering, but the capital gains in the residential property in particular, is basically what you're aiming for. And we've seen in the past, in the history, that the property, the appreciation, the capital growth over the 20 years or more in terms of the compounding growth is exceptional, which I don't know, I haven't got the data in front of me how ETF would compare to that. But that's definitely the main reason why I would be looking at property at the moment, is for that longer term capital growth appreciation. Short term, there will be a lot of headwinds. There'll be a lot of negativity. So it's difficult, but it's doable. Now, ETF, I have a bit of shares myself. I don't play in the ETF space, but ETF, in my personal opinion, is great for cash flow perspective. Dividends and all that kind of stuff. It gives you a lot more stability. ETF/LICs, LICs in that instance, gives you a lot more stability in terms of your money return. So that's probably more of a short to medium term type of play rather than a long term play. This, my personal opinion is, when I made some money from property, and when I want to exit the game, I think it will be a great idea to put money into ETFs and LICs to get that guaranteed return when I needed that passive income to come through. So I think it's important to distinguish the fact that property is not great from a cash flow perspective. Property is great from a capital growth perspective. So it's cash flow wise is very, very poor. Whereas the ETFs, LICs are much better from a return from a cash flow perspective. So it depends on what you're wanting to chase in that instance. Obviously with ETFs, you don't get the landlord issues. You're not going to get calls in the middle of the night to say your toilet's broken down or hot water system's not working. You're not going to get calls from property manager telling you that something's broken down, the roof needs replacement. Yeah. It's going to cost you another 5 digits. All that kind of hassle. So, I think in that sense, I agree. Is it a good time to invest in ETFs rather than property? Yes or no? I think it depends on really where you're at. If you're at the retirement stage, makes sense. But if you're at the initial accumulation stage and you're looking to accumulate capital growth, yes, property is not the easiest, but I would still say do it. That's my stance.
Fantastic. And so much to talk about. I want to, so I want to start with one of the things you said before about the capital growth, and one of the things that makes real estate magical is that because you've got leverage in the mix, and you don't really have leverage in an ETF or shares. I mean, you can get their margin products, but it's generally not a leveraged product. Very mediocre returns in real estate can still be magic. It can still be amazing. You can still drive your wealth, even if you're. So comparing nominal growth to real estate to nominal growth in the share market isn't really fair to real estate, because in real estate there's a lot of leverage, and so it actually magnifies what may be small nominal gains into big life-changing amounts of wealth. And you're right that real estate is an excellent way to it's more about generation of wealth rather than generation of cash flow.
Yes.
And you may have different priorities in different stages of life, but it's good to know that it's really not a cash flow game, at least not initially. It can be later on.
Correct.
But it's a very good way of generating and storing wealth. All right. So here's my formal opinion on this. So firstly, and I'm sort of, by the way, the property chat, propertychat.com.au is an excellent place to see resource for real estate. So big shout out to the guys who run that. I don't know if real estate was ever meant to be easy. It was always a little bit of a complicated, difficult asset, right? So you needed to get into the market. You needed to negotiate with your bank that you're worthy of being lent to, and it's an asset you control. So you do need to call the plumber out in the last minute. The hot water system is going to break down, and you're going to need a new oven. So don't be surprised that real estate's difficult. If it wasn't difficult, everyone would do it. So yes, so there's that. Second thing is real estate is a bit of a political hot potato. So this week we heard that the Greens want to sort of put caps on rent increases, and there's always been discussions about those sorts of things. Now, no one cares what, let's say, BHP does with its prices, but real estate is different. So real estate is absolutely essential asset because it doubles as accommodation, or maybe it's accommodation that doubles as an investment, the other way around. But yeah, it's a little bit political. It's a lot more sensitive than other assets. So there's always going to be involvement from non-economic actors in the real estate game. So ultimately, I think the question is the trade-off between ETFs, which have ease and liquidity, so you can have access to your cash and you don't need to manage anything. But you're giving to buy real estate. The alternative to those things is real estate where you have control, so you can renovate it. You don't need to share it with anyone. You can make income out of it, and leverage, so it magnifies the gains. Now, my personal view is that I want the control and I want the leverage, and I think it's very telling that banks want to lend to you for real estate, but they don't want to lend to you for ETFs. That should tell you a lot. But ultimately, for me, really, I think Winston Churchill said something like, and I think Teddy Roosevelt said the same thing, which is basically that real estate is the foundation of all wealth. And that's something that's so important. So real estate is pure wealth. And there are products out there that maybe derive their value from real estate, but real estate is the core, it's the essential wealth at the end of the pyramid. So I want to own real wealth. ETFs are a proxy, a digital tokenized proxy for wealth. Shares are a fractionalized representation of a company, but real estate is the real wealth. And so for me, and again, it's no surprise because I'm completely biased, but for me, real estate makes sense. I would, generally speaking, not like to sell real estate to buy an ETF. Again, selling real wealth to buy a fractionalized representation of wealth. But I get the liquidity bit. So, and I do own some ETFs as well. So, but real estate is where it's at for me.
Yeah.
Yes,
Pros and cons of each, really, at the end of the day, right? So, yeah, like I said, I think it really comes down to where you are at the moment, what you're looking to do. You're looking for cash flow? Are you looking for capital growth? What's your financial circumstance going to be in the next 5 to 10 years? All that kind of things plays a factor in terms of, property or ETF or whichever type of investment strategy that you want to do. Which is all, John, very, very valid points. I think I do agree with you, and I like the fact that you pointed out property is actually all about being able to control the asset to a degree. You hold on to, you have the ability to be able to decide what you want to do to the property to a certain degree, of course, within council approval, that kind of stuff. You want to do bigger than that. But you got the option to be able to renovate. You got to be able to, sell if you want to as well, depending on when you want to exit the game. That's the part that we like it. And of course, as a landlord, you decide when you want to increase the rent, assuming that the government doesn't intervene anymore. sense, right? So, but as soon as the asset start to lose some of these, which I know that was a reason why we started to come on Property Chat, is there's a lot of talks about the government restrictions in terms of even just the ability to be able to increase the rent whenever the landlords want, right? That's what sparked doubts around, are we started to lose that ability to be able to control the asset the way that we wanted to? So I think
yes, that's right. That's right.
Yeah, that's the question that comes.
That's right. That's right. Because they're not going to put a cap on the price of hot water systems, and they're not going to put a cap on the price of ovens. They're going to put a cap on the price of rent. So it's it's madness. Actually, it's insane. Inflation is something that comes from the central bank, often through funding budget deficits. But when M2 increases, when the supply of currency increases, landlords, private enterprise respond to the inflation by putting the price up. But it means that higher prices are the response to inflation, but higher prices in and of itself is not inflation. It's a response to inflation. So the inflation is when they print money, and then landlords have to respond to that by putting prices up. So so they have to leave it alone. But and if they don't want higher rents, they need to stop printing money. That's how you solve that problem.
I wonder whether they will stop printing money anymore.
No, of course not.
Line, right? That's a fundamental inflationary system that we currently live in at the moment. So
it's a tax. It's a tax, and that's why they won't stop. That's why buying real estate or any inflation hedge makes sense, because you don't want to assume that for some reason the system's going to change and that inflation's going away.
Yeah,
prices are going to go up because that's baked into the banking system. So
yeah, wise words. I think we'll wrap it up there. But it sounds a bit so awesome. All right, well, thank you, listeners, for joining us again another week. And as always, this is basically just two property guys giving it a rant. So before you make any decision, make sure you run past your accountants, brokers, tax advisors, whoever, financial advisors, to make sure that the decision you make is appropriate for you. All right. Well, so until next week, we will see you guys again in another episode of Spark Your Fire. Cheers, John and David.